The following production is presented by League Info Site and the Credit Union Broadcast Experience, QTV.
Hello, I'm Sean Wolbert. Thank you for joining me at the CU Compliance Connection by InfoSite on Cube TV. On January 10th, the Consumer Financial Protection Bureau amended the Truth in Lending Act, or Regulation Z, to implement mandatory escrow requirements dictated by the Dodd-Frank Wall Street Reform and Consumer Protection Act. The new rule was written to establish escrow accounts for higher-priced mortgage transactions to help ensure that members set aside funds to pay property taxes and premiums for homeowners insurance and other mortgage-related insurance required by a creditor. Regulation Z currently requires creditors to establish escrow accounts for higher-priced mortgage loans secured by a first lien on a principal dwelling for 1 year after the loan is originated. The new rule implements requirements of the Dodd-Frank Act that lengthen the time the mandatory escrow account must be established for a higher-priced mortgage loan. As with all regulations, it is important to understand the definitions for the terms that delineate important provisions of the rule. The CFPB escrow requirements define a higher-priced mortgage loan as a closed-end loan secured by a principal dwelling with an annual percentage rate, or APR, that exceeds the average prime offer rate for comparable transactions as of the date the interest rate is set. This is further distinguished by rate differences greater than the average prime rate offer. High-priced mortgage loans are also determined by an APR 1.5 or more percentage points higher than the average prime rate offer for principal amounts that do not exceed Freddie Mac limits, by 2.5 or more percentage points for principal amounts that exceed Freddie Mac limits, or by 3.5 percentage points for loans secured by subordinate liens. A dwelling includes structures that are classified as personal property under state law and can include manufactured homes, boats, and trailers. This is noted in the official staff commentary. The CFPB has stated that the average prime rate offer is an annual percentage rate derived from the average interest rates, points, and other loan pricing terms currently offered to consumers by a representative sample of creditors for mortgage transactions that have low-risk pricing characteristics. The Bureau will publish the average prime offer rates for a broad range of types of transactions in a table updated at least weekly, as the methodology the Bureau uses to derive these rates. Escrow accounts for high-priced mortgage loans will be required for a minimum of 5 years. The rule further stipulates that a creditor may not extend a high-priced mortgage loan secured by a first lien on a consumer's principal dwelling unless an escrow account is established before loan origination for payment of property taxes and premiums for mortgage-related insurance required by the creditor. The items that are required by the rule to be incorporated in the mandatory escrow account include property taxes, hazard insurance, which includes insurance against loss for damage to property, liability insurance to protect the property owner against liability arising out of ownership or use of the property, and private mortgage insurance protecting the creditor against the consumer's default or other credit loss. The final rule does include several exemptions which should make compliance easier for many credit unions. Certain mortgage products do not require the establishment of escrow accounts based on the new escrow account amendment to the rule. Exempt mortgage products include reverse mortgages, a loan transaction secured by shares in a cooperative, construction loans, or bridge loans or temporary loans of 12 months or less. An example of a temporary loan would be a loan to purchase a new dwelling where the member plans to sell their current dwelling within 12 months. It is also important to note that if the property is in a community association that purchases homeowners insurance for everyone in the development, the creditor would only have to escrow for property taxes and not insurance premiums. This most commonly occurs in planned unit developments, condominiums, and other common interest communities. The final rule expands upon an existing exemption from escrowing for insurance premiums for condominium units where a consumer's property is covered by a master insurance policy. The rule also provides an exemption for small credit unions that meet all 4 of the following requirements. First, the credit union has an asset size less than $2 billion. Second, it makes more than half of its first lien mortgages in rural or underserved areas during the previous calendar year. Third, together with its affiliates, it has originated 500 or fewer first lien mortgages during the preceding calendar year. And fourth, together with its affiliates, not have escrowed for any mortgages it or its affiliate currently services, except in limited circumstances. When a credit union meets all four of these requirements and plans to hold the mortgage in portfolio, they are exempt from the new escrow requirements. It is important for me to note here that the exemption only applies if all four requirements are met and the mortgages will be held within the lender's portfolio. Regarding the exemption requirement that half a credit union's first lien mortgages be originated from rural or underserved areas, the final rule exemption clarifies that a credit union must have made more than half of its first lien covered transactions in counties designated as rural or underserved. A county qualifies as rural if during a calendar year it is neither in a metropolitan statistical area nor in a micropolitan statistical area that is adjacent to a metropolitan statistical area. A county is underserved if HMDA data for the year reports that no more than 2 creditors extend covered transactions secured by a first lien 5 or more times in the county in the past year. The CFPB will publish a list of counties that qualify as rural or underserved annually. Often, a question will arise on the ability of a member to cancel their escrow account or request that certain items be paid independently and not included in escrow. According to the requirements of the regulation, a credit union may only cancel the required escrow account if the underlying debt obligation is paid off, or if a member requests termination of the escrow account at least 5 years after its consummation. If the member does request to have the escrow account canceled after the 5-year required term, the credit union cannot cancel the escrow account unless the unpaid principal balance on the loan is less than 80% of the original value of the property securing the mortgage, and the member is not delinquent or in default of their mortgage requirements. The escrow requirements that the CFPB introduced to amend Regulation Z are effective June 1st, 2013, so there is very little time to implement the new requirements. We have come to the conclusion of this review on the CFPB's amended escrow rules based on the Dodd-Frank Wall Street Reform and Consumer Protection Act. Please stay tuned to the Compliance Connection for detailed reviews of the additional new CFPB's requirements. Thank you for joining me. I'm Shawn Wolbert with the CU Compliance Connection by InfoSight, only on Cube TV.
Thanks for watching the #1 compliance program for the credit union community. Stay tuned.